Welcome back to lesson 2 of this course, and in this video we're going to be speaking about risk management, and overall I'm going to be teaching you how to manage your risk in trading and how to stay in the market and without getting liquidated and losing your whole account like you probably already have done. Right, so let's jump straight into it right now. And overall in this video I'm going to be speaking about the general remarks of risk management, the invalidation with the volatility based, time based, price based, and how you can invalidate yourself win them trades, stop losses on a hard stop or a soft stop, position sizing, and your overall risk per trade with a calculation and varying between your position sizes for that specific trade, risk to rewards, streaks, and streaks goes into a lot with psychology and how sometimes your risk to rewards or risk management will be varied because of the streaks that you have with trading, and also like break even and partial profits with some trades on how to manage a trade if you take TPs, and overall leverage trading. So let's jump straight into it. Overall, for general remarks, your number one criteria for trading is going to be survival. You are literally like a little goldfish in an ocean. There's a very high chance that if you don't be careful, you will be eaten up. So survival is your main priority when it comes to trading. And obviously this video will offer basic framework. The rest is upon you. I'm just going to be teaching you something that I know from my own perspective with risk management, and something that needs to be added into my own trading systems day to day out. And focus obviously be on practical and accessible to your own strategies, but if you want the full quantitative approach, go somewhere else. This is a basic explanation of risk management throughout this video, so that's all you're gonna get. And obviously you're here to gamble on coins, to trade crypto, to trade random shit coins that are pumping. Whatever you decide to trade on, you are trading on crypto. We're not reading about fairy tales. And obviously calculate the expectations of your backtested strategies that you trade upon. Everyone's got a different strategy and not everyone trades the same way that you do. So obviously all these are going to be calculated by your own strategies that you choose to trade on. Ideally, as long as you don't blow your account, you have time to find out a market edge as well to strengthen your strategy. Because if you are liquidated and you have no account at all, you will always have the opportunity to make a trade in the future, and you won't have that gut feeling thinking like, oh, why didn't I just risk a little bit less? I didn't need to go that hard into that trade. And you can improve your trading and create an edge in the market. And overall, as well as this, never risk your ability to take risk. Very, very important. Now let's go into invalidation, guys. All right, so the basic premise is you take a trade and you risk money because you have an idea. Whatever made you choose to go for a long position, to go for a short position, is all upon you and your strategy that you've backtested. And well, I'm hoping anyways, because if you're trading upon a strategy that you haven't even tested yourself and you're completely new to, risk management is definitely something that you should be looking out for, because if you don't do that, then I can guarantee you would not last long in this space. So with invalidation, obviously, your idea may reach to a point sometimes at which it is most likely no longer correct. And this is where invalidation comes in. As well as this, or at very least, evidence suggests that you are probably on the idea coming to fruition that is reduced, such as the risk is no longer justified. So at some point, you will understand that that trade was no longer validated. So you know that invalidation has hit and you should not be in that trade anymore. So this is known as invalidation. If your idea doesn't have an invalidation, then you should reconsider it. Because how are you making a trade and knowing full well damn sure that that trade is going to happen? Because if someone knows what's going to happen in the market, then you are a time traveler. Not everyone knows what's going to happen in the markets. So you must have a plan to fall back upon and be invalidated for that trade. If your idea also doesn't have a basis in the first place, there is no idea at all. Go back to the drawing board, right? It's just stupid, all right? The invalidation is usually a product of the idea itself is built in. Now, price-based, let's think about this, right? So the idea is that when you are in a trade and you think, okay, so I've got support at 18,500, and if the price hits that, let's say 10 pips below for Forex traders, and for crypto, let's say it's gone like $10 below, and that's my stop loss. The whole idea is that the level support, if it's invalidated and it breaks it, X failed to access support, that's the invalidation gone. That's a price-based invalidation that you are using as a strategy for invalidation. Now, time-based is an idea that a price should consecutively close above X to suggest a breakout, or invalidation equals closing below X. All right. Now, candle close can also be an invalidation for this. If, for instance, a candle close doesn't close as quick as you wanted it to, then that's going to be your invalidation for that trade. The idea is also that the price usually moves X percentage-wise within Y hours after Z takes place, invalidation. Price not moving fast enough within Y time frame following Z. So you could be like, this shit isn't moving as quickly as you wanted it to, and for that type of setup, it is invalidation. So sometimes when you can realize that support is broken and your trade idea was that if you are invalidated, it's basically on a full-blown blast through the support zone. Not a hit of support zone, but a full breakout of that support. And therefore, that's how the price... that's how time-based invalidation is run through, and I actually do use that myself a lot. I don't really go upon price-based invalidation, but this is obviously for everyone else out there who have their own strategies. As well as this, the idea that the market usually does X within Y time period trading sessions. Invalidation equals price not doing X within Y time period of trading session. New York opening's gonna moon it. Wait, where on earth is a bid? Invalidation. Boom. So if you know, sometimes on events such as New York Open, Sessions Open, whatever, etc., news events, CPI reports, if you understand that you wanted to have a trade based upon that and that the price didn't go up or down based off of that, that's invalidation. All right, that's another whole idea of invalidation for your trades. Also, volatility based. The idea is that the price usually moves a percentage-wise within Y hours, so 10 minutes, 2 minutes, 10 hours, whatever it is, after Z takes place. So an event equals invalidation, price moving less than X within Y frame following Z. I wasn't expecting dildos, but I'm getting a shit to all invalidation. So there are all overall your invalidation ideas on how you can be invalidated for your trades. So highly take into consideration what kind of validation that you have and how you can make sure that you have one for your trades, and if you can follow it and not forget about it during your trades. Now, let's move to stop losses, guys. All right, this is very important. So not all traders with their trades have an obvious outright stop loss. So such as me, that's very alike for me. So examples sometimes less clear with time-based volatility-based examples. At the same time, some setups present a very clear place for a stop. Example, a price-based failed breakout, breakdown setups. This is mainly me. This is what my kind of stop losses is, and it's through a breakdown of a setup and not based off price, just overall setup. Basic premise is stop loss is an order, often but not always a market order, to fully close the position in a certain price or loss threshold. Market order guaranteed execution. Full price may be unfavorable. Limit order, if it skips your price and the market teleports, you're fucked. That's pretty self-explanatory. TLDR version, stop placing trades and where they should be. The setup obviously calls for it. Clear invalidation in line with the trade idea. The idea is obviously wrong if price trades to the stop order, and 99% of complaints about stop hunting or price quick are reversed on me, shit stop placement, and it's hunting. So obviously markets know where most of the stop hunts are, where people are putting their stop losses, and you know what happens. So have a strategy for stop losses. Let's go to stop losses 2. As before, stop placement is linked with the trade idea itself. If a shit idea, it's got also a shit stop placement, most likely. All right, it's pretty obvious. And if you don't know where to put a stop loss, that often means the idea itself is not defined very clearly, or that the setup isn't particularly good. So obviously, if you go into a trade at a random time, trying to catch a bottom trade for a long position, and you don't have a stop loss in a certain period of time, when you enter a trade and it goes down upon you and you haven't even made yourself have a stop loss, you're fucked. Like, you need to understand that most likely with all your trades, you need to have invalidation and also a stop loss. So you enter that trade, and if you want to be going out of that trade, if it's invalidated, where are you stopping out? You need to figure out where to place these stop losses, guys. All right, it's very important. Now, simple eye test: would I want to buy when my long gets stopped out, or would I want to sell where my short gets stopped out? All right. So think about that in terms of trading when you want to make a long position or a short position. If the answer is yes, consider revising, especially if you are trading technicals. All right, it's pretty easy. Now, stop loss number 3. Strictness with stop usage and placement inversely correlated with the size of the move you're trying to trade. Hot take: if you're punting low time frame, tight rotations with nearby invalidation and lot size, stop placement needs to be strict because the idea must be precise to be correct. If you're swing trading a higher time frame, value area, especially if there are liquidations and an outsized move coming onto the level, stop placement can be loser because trade idea is valid over a wider area. Hard stop: mark your order to close the full position at a certain price or a loss threshold, appropriate for clearly defined setups and or setups where entry is close to invalidation. Usually means more size, as we'll discuss. Soft stop: mental stop to start closing out the position, mix of limit and market orders. And this is kind of like what I do. I like to do soft stops to kind of like size out of my trades, and sometimes I'll do hard stops, but most likely soft stops to kind of like scale out of my trades. So invalidation criteria begins to be satisfied, appropriate for swing trade ideas, less reliant on short-term precision. So such as people who are trying to catch the bottom, you obviously know the price going in a very fast time manner, most likely if it's at the bottom, because a lot of liquidity comes in, and you know that doing soft stop loss on that area is definitely not a good idea because the price can move very quickly. So most likely a hard stop will be a better idea for that specific trade. Use hard stops if you're a beginner because your ideas probably suck, which is pretty obvious because how are you going to know how to scale out at a certain point in time, or even the best times for that specific trade on that region. They'll also teach you more about the stop placements by studying what the market does. If anything, after taking you out, read Trading Riot Risk Management blog post for some cool ideas. Guys, Trading Riot is a very good trader, and I recommend to read his risk management because he's got a good blog as well, and you can actually learn a lot from him as well. So that's really it for stop losses, and I hope you can understand a little bit more about that and how to execute your stop losses better in trading. Now, position sizing and risk per trade. This is a very important one for a lot of new traders who tend to get greedy because they understand that leverage comes into point here as well. They see the opportunity to take a 125x leverage trade for Bitcoin, and they sometimes probably will win one trade or two trades, and they'll probably even start a streak, which we'll talk about in a little bit, right? But let's say a trader takes a trade and they use a very high leverage and they make a lot of money in their first trade by accident, right? Maybe he's a new trader who doesn't even know how to trade, but thinks he's a very smart person. He doesn't even know anything about position sizing. So this is going to be very, very crucial, because what if now that the trader keeps on making them trades and eventually he loses a very big trade and goes back to zero, and he enters more trades because he thinks like, okay, so that's a very unlucky trade. We know we can still win, but eventually he'll get stopped out and his whole account's gone, right? This is the main reason a lot of people fail, I think, and position sizing is very important and your overall risk per trade. So position sizing and risk per trade are two different things. Position size is the number of units of an instrument bought or sold. And the risk per trade is the percentage of portfolio of your own portfolio, or the amount a trade stands to lose upon invalidation. If you have an invalidation point, calculating position size is straightforward, pretty easy. Position size equals portfolio times risk, distance to invalidation. Position size equals number of contracts of what you're trading, whether it be Bitcoin, Forex, whatever. Portfolio equals total trading capital. So how much you own in your own trading account, what you're trading with. Risk percent is the percentage of your portfolio at risk, expressed as a decimal. So now when you trade on Binance or wherever you trade on, it will tell you risk within that trade of your account. Okay, so we'll see in a bit on how to calculate that, or even what's the best risk for your account, or even obviously different trades are different, right? Some do high risk, some do low risk, but obviously we'll talk about it in a minute. So distance to invalidation as well is the distance between your entry and invalidation, expressed as a decimal. So that could be your liquidation. If you enter a trade, it's either you have a stop loss or you have invalidation at the liquidation. All right, simple as that. For example, $100,000 equity at a 2% risk with an invalidation of a 5% away trade. Here we go. Position size equals portfolio at risk, distance to invalidation. Position size 100K, obviously, and 0.02, which is 2%, and divided that by 0.05 with a 5% move away. Position size equals $40,000. Checking the maths, if 40K USD moves at 5% and hits my stop loss, 40K times 0.05 equals 2K lost, which is 2% of $100K. This doesn't account for slippage, fees, etc. So obviously you'll have extra fees on top of your trade, which you need to hold up on. So normally with a 2K trade, you would probably get a fee about $100 sometimes with high leverage, and if not, like around about $30 then without high leverage. So basic premise is you take a trade and you risk money because you have an idea, right? Everyone trades because you have an idea of where the price is going to go to in the future. Your idea may reach a point at which it most likely no longer is correct, or at very least evidence suggests that probably. Oh, this is actually wrong. I'm sorry, guys. So dynamic risk to reward ratio. Here we go. Let's move on to the risk to reward ratio of your trades. So basic premise is that the risk to reward ratio of a trade evolves as price moves away from your entry point. Idea is to make sure that you're not being complacent in a trade management. Example, buy at 50, target 100, stop at 25. All right. You're risking 25. So 50 minus 25 for a gain of 50 to obviously 100, take away 50. Reward divided by risk equals 50 divided by 25 equals 2R. So here I'll show you guys real quick of what I'm talking about. So if we go into here and we make, for instance, a long position trade, let's move this to a green color. So overall, if you are in a trade and you have a 1-to-1 risk to ratio, here we go. The price comes in like this, and you enter a trade for a long position right there. Let me actually open up a PC. So, okay, it's not letting me do it for some reason. Doesn't matter. So let's say the price comes into your box where you want to make a long position. 1-to-1 risk to ratio is here. So you will basically be trading $10,000 or whatever it is right here for a long position, and your stop losses is going to be here. If the stop losses goes here and the price eventually hits it, you will eventually lose 10K USDT or whatever you're trading with, etc. Right? And now if the price goes up to here, like so, and your TP gets hit and you go exit the trade, eventually you will have another 10K on top of you, meaning that if you enter the trade with 10K, you'll now have $20,000. This is a 1-to-1 risk to reward ratio trade. And if eventually you either have 2R here, you have 1R here, and you have 0R here, okay? So when you enter a trade, think of most likely what is going to be the outcome of the trade, all right? And sometimes there'll even be trades with like a very tight stop loss, such as like this. This is a 9R trade. So let me explain to you right now how that's going to work out and how much money you'll get for a 9R trade. Delete this real quick. For some reason we can't add in a different drawing tool because this one's kind of weird. So eventually the price comes to the box like this, and you are in there now. your stop loss is going to be here. You'll calculate how much you will lose from here to have 0R. Okay, here is your 1R still, and eventually, with this being a 9R trade, you will have 9R here. But what is the actual potential probability that this will happen? So the probability of this touching here is very high because it's very close, but the probability of it hitting here is very high, very low because it's very far away from the price. So you are risking 1R to get 9R, but you are risking a very low probability that your actually stop loss gets taken. So this is what I'm talking about by risk positioning and your overall risk to reward ratio. Okay, so let's go over to guys. So the point of evolving R is to ensure that your trade always satisfies some arbitrary ratio. Instead, there's a wake-up call or a trade management signal once the market approaches your take profit or stop losses. Common remedies to address poor evolved risk to reward: close the position and or move stop losses. Work to the downside as well. Don't always have to wait for the market to take your stop losses if there's compelling evidence that the probabilities have shifted against you. So sometimes if the actual stop loss gets taken and your risk is out, sometimes you need to look at trade and think, okay, wait, maybe my stop loss was wrong and I did a wrong level, the price hit it and it went back up. So it's just like stop hunting traders. So let's move on to risk reward ratio cheat sheet. You guys can screenshot if you want to. Right here is a little risk to reward spreadsheet on your trade and how much you will earn with the amount that you risk with. Go ahead and read it. It will help you out a ton amount if you want to. And it also shows you your win rate for your strategy and if you should take them trades. So streaks. This goes in with psychology with trading, and obviously streaks have consecutive wins and losses. Streaks can offer a very informative idea about changes in the market, regime, and our specific setup. Dumb shit to avoid with streaks, guys. Risking more when losing to make it all back. And this goes to a lot of people in trading, especially me, who I used to do that a lot. Still sometimes do, and sometimes need to discipline myself. And it's a very, very good skill to have if you discipline yourself, if you risk if you just avoid risking more when the trade is losing because you want to make it all back. Risking more on losing setups while other setups are doing well. Risking less when winning to accumulate karma points from the market for not being greedy. Risking less on winning setups following a losing streak on a different setup. And also ditching a profitable setup after a small string losses. What's the point if you know a trade is going to go very well with the criteria it had before and the overall outcomes of them trades, just because you have had a few losses in the market? Your setups are still there, okay? They're going to get validated and your setup will be there for you to take. Don't just not take it because you had a bad streak on the day. Your setups are still there for you to take. Just because it's a streak of a loss doesn't mean you cannot enter a trade again. Now, so smart stuff to consider is which setups are working well or not longer working. Example, trending setups start losing while ranging setups start printing. Changing conditions and regime in the markets. So sometimes you have a trend of a short position favored and you're looking for long positions. Sometimes it's good to actually consider why these setups are working or not and what kind of market condition you are in. If something is not working well, trade it less and or with a smaller size and or be more selective with it. As I just said, if a novel or a short-term edge stops printing, bin it if they usually don't come back. Short-term streaks don't necessarily mean a setup is trash or fantastic. Variance, incorrectly identifying setups, shifting conditions, shit happens. Exactly. As I just said, guys, understand market conditions and sometimes don't invalidate them just because you're in a bad market condition for that specific trade setup, because most likely you'll have different setup conditions that you take for each short position, long position, or even specific different trade strategies in overall your knowledge. Be nimble, some variance is expected. Try to think about what the streak is telling you. Sometimes it's nothing, but other times you get clues of the shift in conditions when the staple setups start printing. Impossible to do anything with this our journal. So obviously trade journals If you guys actually do that yourself, I advise you to do that if you don't. But if you do, very good. You'll understand more about your own trading strategies and your overall past with them strategies and how they maybe failed, maybe even won you, and what kind of market condition was that trade in. And when you understand them trading setups, with them market conditions, you'll be able to take advantage in the upcoming future when that same market condition is there, and you'll know what trade setup wins and what losses, or maybe even what to stay away from within that market range that you know you're currently in. So it definitely helps your strategy, and it kind of adds an edge to your trading career. Now, break-even stops and also partial profits. Stop to breaks even, free trade now, bullshit. Took some off here, can never go broke taking profit. Also bullshit. Most break-even, stop, and partial profit decisions are made to achieve psychological comfort, not because those decisions improve the trade outcomes in the long run. It's not the market's job to make you feel cozy. Seek therapy out. The market doesn't also care about your entry, target, stop losses, and unrealized P&L. Making decisions to preserve the sanctity of the arbitrary figures is a futile attempt to impose your will on the market. Break-even stops, trade management decisions should never be an arbitrary and should almost always be derived to some extent from a trade idea itself. There's probably nothing special about your exact entry and the specific unrealized P&L, derived therefrom not a good basis for making trade management decisions. It's not a free trade as well if the cost is sacrificing the potential gain from your trade idea by not letting it play out properly. For technical traders, break even stop on a long, I am bearish in the same place that I bought previously. Break even stop on a short, I am bullish in the same place that I sold previously. And sometimes that will be true and reasonable, but more often than not is simply a coping mechanism and an attempt to avoid uncertainty in the market. Example, can be justifiable where revisiting an entry invalidates the idea makes the setup very likely to fail. So I hope you guys understand about breaks even and partial profits. It's very important for you to take advantage of this and not to just do it because you feel comfortable with it. And in the market, just because it goes back, you had it all along because you broke even, etc. Sometimes taking profits is better than not taking profits because eventually you will actually get credited for taking a trade correctly instead of just not taking anything from that trade because it missed by 2 pips or $10 or whatever it is. So taking profit is very, very important sometimes, guys. So also going to the second conclusion of breaks even stop losses is that similar reasoning regarding partial profits can be justified in certain situations. Example, evolving are examples. But arbitrary closing trades are early based and non-market factors like P&L alone will likely harm you in the long run. Because if you guys stress yourself too much about P&L, it's all about your own psychological terms of, oh yeah, making loads of money. You guys need to stay away from doing that because eventually you're going to get too ahead of yourself in the markets, and overall break even and stop losses, TPs will just be out the window and you won't care about them, and you get greedy in the markets. All right. Good trading is process oriented and not being a slave to the short term or red green on your screen. So looking at your red green on your P&L all the time, guys, is not a good idea to do because eventually your psychological mind will be irritated and you won't even think straight to your trading. All right. The cost to break even stop losses in the long run, you probably perform better by letting your setup logic play out. Literally, it makes perfect sense, right? Cost to taking profits early in the long run, you probably perform better by letting your setup logic play out. Even if this is not true, if you manage trades accordingly to a system or somewhat objective criteria, you can at least review that data and optimize your trade management. Randomly closing trades that does not give you any useful information or actionable information. Best case, closing early isn't harming you in the long run, but you can't optimize it because the decision itself is arbitrary in most cases. Worst base case, closing early is harming you in the long run, and the decision-making process is too arbitrary and opaque to be helpful. Unlikely, I close winning trades when I feel my pick is an edge. So there you go, guys. That's it for break-even, stops, and partial profits. I think that's the end of the... Yes, it is. So I hope you guys learned quite a lot from my PowerPoint. We talk about a lot of stuff such as invalidation, stop losses, position sizing, and risk per trade, which is a very important one for you guys, risk to reward ratio, and streaks, and break even partial profits. So if you guys are new around here, please leave a like on the video and subscribe, post notifications, helps out a lot, and I'll be posting out lesson number 3 tomorrow.